So in some contracts, the transaction price isn't as clear. Specific situations affecting the transaction price include variable consideration and the constraint of its recognition, sales with the right of return, a particular type of variable consideration, identifying whether the seller is acting as a principal or as an agent, the time value of money, and then payments by the seller to the customer. So variable consideration occurs when part of the transaction price depends on the outcome of future events. Examples of variable consideration include incentive payments in the construction industry, royalties in entertainment and media, Medicare and Medicaid reimbursements in the healthcare industry, volume discounts and product returns in manufacturing, and rebates in the telecommunications industry. Variable consideration is estimated as either the expected value or the most likely amount. If there are several possible outcomes, the expected value method of estimation will be appropriate. Expected values are calculated by summing the product of each possible amount and its probability. On the other hand, if only two outcomes are possible, the most likely amount might be the best indication of the amount the seller will likely receive. As an example of accounting for variable considerations, let's assume TrueTech enters into a contract with Pro Sport Gaming to add Pro Sport's online games to the TriNet network. Pro Sport offers popular games like Brawl of Bands and wants those games offered on the TriNet so Pro Sport can sell gems, weapons, health portions, and other game features that allow players to advance more quickly in a game. So on January 1st of 2018, Pro Sport pays TrueTech an upfront fixed fee of $300,000 for 6 months of featured access. Pro Sport also will pay TrueTech a bonus of $180,000 if TriNet users access Pro Sport games for at least 15,000 hours during the 6-month period. TrueTech estimates a 75% chance that it will achieve the usage target and receive the $180,000 bonus. So on January 1st of 2018, TrueTech records the cash received for the upfront fixed fee of $300,000. How TrueTech treats the potential bonus of $180,000 depends on whether it estimates the transaction price based on the expected value or the most likely amount. First, we'll look at the expected value method. Now, this method calculates the probability-weighted transaction price. So alternative 1, the expected value, would be calculated as a probability-weighted transaction price, which basically is the possible amounts of $480,000, which would be a $300,000 fixed fee plus the $180,000 bonus, times a 75% probability would give you an expected amount of $360,000. Then we've got a $300,000 fixed fee plus 0 bonus times a 25% chance that would incur would provide you with a $75,000 expected amount. TrueTech estimates a 75% chance it's going to achieve the usage target and receive the $180,000 bonus. So the TrueTech estimates a 75% chance it's going to receive the $480,000, which weights out into $360,000. And then it estimates a 25% chance it's going to miss the target. Therefore, the total expected value of the contract price at inception is the $360,000 plus the $75,000 for a total of $435,000. Now let's estimate the contract price as the most likely amount. There is a greater chance of qualifying for the bonus than of not qualifying for the bonus. Therefore, the transaction price would be $300,000 plus $180,000 or $480,000. Continuing to estimate the transaction price as the most likely amount, let's see how TrueTech recognizes revenue. TrueTech would recognize 1/6 of the estimated revenue each month for the next 6 months totaling $480,000, which would be that divided by 6, or $80,000 per month. Part of this $80,000 is 1 month's worth of deferred revenue that's now recognized as revenue, which would be the $300,000 fixed divided by 6 months, or $50,000. And the other part is estimated bonus receivable, which is the $180,000 divided by 6 months, or $30,000. At the end of 6 months, TrueTech would know whether or not the usage of ProSport's product had reached the bonus threshold. In either case, TrueTech's deferred revenue account would have been reduced to a zero balance, and the bonus receivable account would have a balance of $180,000 that would need to be reduced to zero. TrueTech either would record an increase in cash if the bonus is received, or a decrease in revenue if the bonus is in fact not received. Companies make adjustments to estimated variable consideration over time as new information becomes available. So to see this, let's assume TrueTech started recognizing revenue under the assumption that the most likely outcome was that it would receive the bonus. But after 3 months, TrueTech concludes that due to low usage of ProSports games, the most likely outcome is that it's not going to receive the $180,000 bonus. So in April, TrueTech would reduce its bonus receivable balance of $90,000 down to zero, and would reflect that adjustment in revenue by reducing service revenue by $90,000. For the remainder of the contract, TrueTech only recognizes revenue in each month associated with the upfront fixed payment of $300,000. As $150,000 is the remaining amount to be recognized of the $300,000 in April, TrueTech recognizes $50,000 each month for 3 months. Let's check another question here. So Citi enters into a contract offering variable consideration. The contract pays Citi $2,000 a month for 6 months of continuous consulting services. In addition, there's a 60% chance the contract will pay an additional $4,000, and a 40% chance the contract will pay an additional $6,000, depending on the outcome of the consulting contract. Citi concludes that this contract qualifies for revenue recognition over time. Let's assume Citi estimates that variable consideration as the most likely amount. What is the amount of revenue Citi would recognize for the first month of the contract? B, because the most likely outcome is that Citi receives the $4,000 bonus, which is the 60% likelihood, in which case Citi would be paid a total of $2,000 times 6 months plus $4,000, or $16,000. Therefore, Citi would recognize the $16,000 divided by 6 months, or $26.66 each month. Let's say Citi enters into a contract offering variable consideration. Again, same results. Citi concludes this contract qualifies for revenue recognition over time. So let's assume Citi estimates variable consideration at the expected value. What's the amount of revenue Citi would recognize then? Well, what we would do in this case is we would take $2,000 a month times 6 months, plus we would prorate the probability 60% times 40,000 plus the 40% times 6,000. In this case, we would take 16,800 and divide that by 6 months to give us $2,800 each month. As you can see from our example, sellers record revenue based on their estimates of variable consideration to be received in the future. A concern is that the seller might overestimate the variable consideration and recognize revenue based on a transaction price that's way too high. That would require the seller to later reverse that revenue and reduce the net income in order to correct the estimate. So to reduce the chance of that occurring, Sellers are constrained to only include an estimate of variable consideration in the transaction price to the extent it is probable that a significant revenue reversal will not occur when the uncertainty associated with the variable consideration gets resolved. Indicators that a significant revenue reversal could occur include some poor evidence on which to base an estimate, dependence on the estimate on factors outside the seller's control, a history of the seller changing payment terms on similar contracts, a broad range of outcomes that could occur, and a long delay before the uncertainty resolves. Sellers update their estimate of variable consideration each period, including their conclusion as to whether variable consideration should be constrained. Those changes in estimates are recorded to revenue in the current period. So which of the following is not an indicator that the constraint on recognizing variable consideration should be applied? Is it A, a broad range of outcomes could occur, B, poor or limited evidence on which to base an estimate, C, a short delay before uncertainty resolves, or D, a history of the seller changing payment terms on similar contracts? Well, a long delay before uncertainty resolves in an indicator that the constraint applies, but not a short delay. So assume that initially TrueTech can't conclude that it is probable that a significant revenue reversal will not occur in the future. In that case, TrueTech is constrained from recognizing revenue associated with variable consideration. It includes only the upfront mixed payment of $300,000 in the transaction price and recognizes revenue of $50,000 each month. On March 31st, after 3 months of the contract have passed, TrueTech concludes it can make an accurate enough bonus estimate for it to be probable that a significant revenue reversal will not occur. So, as you see in this slide, TrueTech estimates a 75% likelihood it will receive the bonus and bases its estimate on the most likely amount of $180,000. Since on March 31st the contract is 1/2 finished, since we've already had 3 out of the 6 months, TrueTech then records a bonus receivable and service revenue for $90,000, which is the $180,000 times 3 months out of the 6 months. The cumulative amount that would have been recognized over the first 3 months of the contract if an estimate of variable consideration had been included in the transaction price to begin with. But in the final 3 months of the contract, TrueTech recognizes the remaining revenue assuming a transaction price of $480,000, recognizing $80,000 of revenue exactly as if it had been included an estimate of variable consideration in that transaction price all along. Retailers usually give customers the right to return merchandise if customers decide they don't want it, or aren't satisfied with it, or just unable to resell it. The right to return merchandise does not create a performance obligation for the seller. Instead, it represents a potential failure to satisfy the original performance obligation to provide goods the customer wants to keep. Because the total amount of cash a seller is entitled to receive depends on the amount of returns, a right of return creates a situation involving variable consideration. Based on past experience, a seller usually can estimate the returns that will be a result for a given volume of sales. So the seller reduces revenue by the estimated returns and records a liability for cash the seller anticipates refunding to the customers. If the seller hasn't yet been paid by the buyer, it might reduce its accounts receivable with a contra account, allowance for sales returns, rather than recognizing a liability to return cash it hasn't received yet. If the seller lacks sufficient information to be able to accurately estimate returns, The constraint on recognizing variable consideration we talked about earlier applies, and the seller should recognize revenue only to the extent it is probable that a significant revenue reversal will not occur later if the estimate of returns change. In fact, the seller might postpone recognizing any revenue until the uncertainty about returns finally gets resolved. Let's see how a company would record revenue when a right of return exists. Assume that TruTech sold 1,000 try boxes to comp stores for $240 each and received payment for that sale. TruTech estimates that comp stores will return 5% of the try boxes purchased. The sales recorded by increasing the cash and sales revenue for $240,000. The estimated return of 5% of sales is recorded in sales returns, a contra revenue, account that has an effect of reducing revenue. A refund liability is also recorded with a credit entry for $12,000. Note that the sales revenue and sales returns accounts could be combined, such that TruTech simply records revenues of 95% of the $240,000 or $228,000. Companies typically don't estimate returns separately for each sale. Also see that if TruTech had not received cash for the sale, it would have an account receivable of $240,000 and would reduce that receivable by $12,000 rather than showing a refund liability for cash it hadn't yet received. So let's look at another question here. Braun Computer Company sells computers with an unconditional right to return the computer if the customer isn't satisfied. Braun has a long history selling these computers under this return policy and can provide precise estimates of the amount of returns associated with each sale. Braun most likely should recognize revenue, A, when Braun delivers a computer to the customer, ignoring potential returns, B, when Braun delivers a computer to a customer in an amount that is reduced by the expected returns, C, when a customer returns a computer, or D, when Braun receives cash from the customer. Well, the right answer here is B. Braun can estimate returns reliably enough for the constraint on recognizing variable consideration to not apply, so Braun would adjust the transaction price for expected returns and recognize revenue in that amount upon the delivery. The transaction price also depends on whether the seller is a principal or an agent. The principal has a primary responsibility for delivering a product or service. It is vulnerable to risks associated with holding inventory, delivering the product or service, and collecting payment from the customer. In contrast, an agent doesn't primarily deliver goods or services, but really acts as a facilitator that receives a commission for helping sellers provide those goods or services to buyers. So an agent's performance obligations to facilitate the transaction between a principal and a customer. If the company's a principal, it records revenue equal to the total sales price paid by customers. It also records cost of goods sold equal to the cost of the item to the company. But if the company's an agent, it records as revenue only the commission it receives on the transaction. As an example of the principal-agent distinction, let's say Mike buys a TriBox module from an online retailer for $290. Let's consider accounting for that sale by two retailers, Printco and Agentco. So Printco purchases TriBox modules directly from TruTech for $240, ships them to its distribution center, and then ships the individual modules to buyers when a sale is made. Here, because Printco is responsible for fulfilling the contract, it bears the risk of holding inventory and has a latitude in setting the sales price. The evidence suggests that Princo is a principal in this transaction. Agent Co. serves as a web portal by which multiple game module manufacturers like TrueTech can offer their products for sale. So the manufacturers ship directly to buyers when a sale is made. Agent Co. receives a $50 commission on each sale that occurs via its web portal. Given that Agent Co. is not primarily responsible for fulfilling the contract, bears no inventory risk, and has no latitude in setting sales price, and is paid on commission, it seems as though Agent Co. is an agent in this transaction. So notice that Princo and Agent Co. record the same amount of gross profit of $50. The difference is just the amounts of revenue and expense recognized and reported in the income statement. Agent Co. records the commission earned as revenue with no cost of goods sold. So here we go again, questions regarding principal or agent. Clayton Consulting operates a website that links experienced statisticians with businesses that need data analyzed. Statisticians post their rates, their qualifications, and references on the website, and Clayton receives a 25% amount of the fee paid to the statisticians in exchange for identifying potential customers. Lovelace Associates contacts Clayton and arranges to pay a consultant $4,500 in exchange for analyzing some data. Clayton's income statement would include the following with respect to this transaction: a revenue of $4,500, a revenue of $4,500 and cost of services of $3,375, a revenue of $1,125, or revenue of $5,625 and cost of services of $4,500. So the key is this person a principal or an agent? Well, it looks like he's an agent. So it doesn't have primary responsibility for delivering the services, and it doesn't collect payment from the customer. Rather, Clayton's primary performance obligations just to facilitate the transaction between the two parties. Therefore, Clayton would recognize as revenue only its commission of the $1,125. Payment and delivery for a performance obligation may happen at different points in time. If delivery and payment occur relatively near each other, then the time value of money doesn't matter and we don't have to worry about it. However, if payment and delivery occur relatively far apart, the time value of money needs to be accounted for. The seller views the transaction price as consisting of the cash price of the good or service and a financing component representing the interest for the time between the sale and the cash payment. The seller then adjusts the transaction price to remove the financing component. That way, the seller recognizes the same amount of revenue for goods and services that it would recognize if the customer paid cash on time. The seller delivers those goods and services. The seller separates accounts for the financing component of the contract over time by recognizing interest revenue in a case of an account receivable or interest expense in the case of a customer prepayment. We're going to talk more about the time value of money in a future chapter. Another transaction price complication occurs when, in addition to selling goods or services, the seller buys goods or services from the customer. If the seller purchases distinct goods or services from the customer at the fair value of those goods and services, we account for that purchase as a separate transaction. But if the seller pays more than the fair value of those goods and services, then the excess payments are viewed as a refund. They are subtracted from the amount the seller is entitled to receive when calculating the transaction price of the sale to the customer. We know that the seller must allocate the transaction price to each performance obligation in a contract in proportion to the standalone selling prices of the goods or services in the contract. When these goods or services aren't sold separately, we can apply various approaches to estimating standalone selling prices, including the adjusted market assessment approach, which would be the seller considers the price it would receive if the product or services were sold in the market in which it normally conducts business. The seller often references prices charged by competitors. Or the expected cost plus margin approach, where the seller estimates the cost of satisfying a performance obligation and then adds an appropriate profit margin. The residual approach, where the seller estimates an unknown standalone selling price by subtracting the sum of the known or estimated standalone selling prices of other goods and services in the contract from the total transaction price of the contract. The residual approach is only allowed if the standalone selling price is very uncertain, which is the case if the seller hasn't previously sold such a good or service and hasn't yet determined a price for it, or if the seller provides the same good or service to a different customer at a substantially different price. So as an example of applying this residual approach, let's assume TruTech sold TriBox systems along with a 1-year TriNet subscription. TruTech is highly uncertain of the standalone selling price of the 1-year subscription, as it hasn't sold that service previously and it hasn't established a price for it. Therefore, to estimate the price, TruTech uses the residual approach. The total price of the package is $250,000 for 1,000 systems, and the standalone price for the TriBox is $240,000. So the difference of $10,000 is estimated to be the standalone price of the TriNet subscription. Based on the relative standalone selling prices, TruTech records the subscription amount as deferred revenue of $10,000. Sales revenues credited for the standalone price of the TriBoxes and accounts receivable is debited for the full amount of $250,000. At the end of 1 year, after its delivered subscription services, TruTech would convert the $10,000 of deferred revenue to revenue by debiting deferred revenue and crediting service revenue. So let's look at another concept question here. Allen Company wrote a contract that involves 2 separate performance obligations. Allen cannot estimate the standalone selling price of a product A. Product B has a standalone selling price of $200. The price for the combined product is $240. How much of the transaction price would be allocated to the performance obligation for delivering product A? Allen would use that residual method, the combined price minus the standalone selling price, to show the $40 would be the price allocated to the contract. Let's take a look now at exercise 5.9. Murky Consultants provided Lamba Construction with assistance in implementing various cost savings initiatives. Murky's contract specifies that it will receive a flat fee of $100,000 and an additional $40,000 if Lamba reaches a pre-specified target amount of cost savings. Murky estimates that there's a 20% chance that Lamba is going to get this cost savings target. So assuming Murky uses the expected value as its estimate of variable consideration, calculate the transaction price. Assuming Murky uses the most likely value as its estimate, we're going to calculate the transaction price. And then third, Assume Mercky uses the expected value as its estimate of variable consideration, but's uncertain of that estimate due to lack of experience with similar consulting arrangements. We'll have to calculate transaction price based on that estimate or assumption. So, in the first way, we're going to use the expected value as its estimate of variable consideration. So, we've got $140,000, the flat fee, and an additional $40,000 if Lambda reaches a pre-specified target of cost savings, assuming there's a 20% chance. So, the probability of doing the bonus is 20%, and the probability of just receiving the flat fee is 80%. So 20% of the 140 is 28,000. 80% of the fixed fee is 80,000. Combined, 108,000 is the expected contract price at inception. Now, assuming we use the likely value as its estimate, then it's going to be just the flat fee of 100,000, because that's a greater chance of not qualifying for the bonus than of qualifying for the bonus. Then, if we use the expected value as its estimate, Mercky can't argue that it is probable that it won't have to reverse a significant amount of revenue in the future. Mercky would not include the bonus estimate in the transaction price, and in this case, it would just be a flat fee of $100,000. Exercise 510. Arctic Guide Service provides guided 1 to 5 day hiking tours throughout the Arctic mountains. Jungle Tours hires Arctic to lead various tours that Jungle sells. Arctic receives $2,000 per tour day, and shortly after the end of each month, Arctic learns whether it's going to receive the $200 bonus per tour day it guided during the previous month, if its service during that month received an average evaluation of excellent by customers. The $2,000 per day and any bonuses that are due are paid in one lump sum payment shortly at the end of each month. On July 1st, based on prior experience, Arctic estimated that there was a 30% chance that it will earn the bonus for July tours. It guided a total of 8 days from July 1st through the 15th. Then on July 16th, based on Arctic's view that it had provided excellent service during the first part of the month, Arctic revised its estimate to an 80% chance it would earn the bonus for the July tours. It also guided customers for 12 days from July 16th through the 31st. But guess what? On August 5th, Arctic learned it did not receive an average evaluation of excellence for its entire July tours, so it would not receive any bonus for July, and received all payment due for the July tours. Arctic bases estimates of variable consideration on the most likely amount it expects to receive. So here we're going to prepare journal entries based on July 15th, July 31st, and then July 5th's journal entries. So on July 15th, what will happen is we will debit our accounts receivable of $16,000. We will credit our service revenue for $16,000. Then on July 31st, we would record accounts receivable of $24,000 and debit our bonus receivable of $4,000 and credit service revenue for the full amount. But then, on August 5th, we need to make some adjustments. We're only going to receive $40,000 in cash, so we debit our cash, we credit our accounts receivable, and then we have to reverse the bonus receivable because it was not received. Now for exercise 513. Media Mars sells a big screen TV package consisting of 60-inch plasma TV, universal remote, and the on-site installation. So again, in this case, we're going to need to estimate the standalone selling price using the adjusted market assessment approach or using the expected cost plus approach or the residual approach. So when we're dealing with the first one, the standalone selling price using the adjusted market approach, we would show the installation service to be $300, the amounts that are charged for customers that are competitors in that service. If we use the expected cost plus margin approach, then we would show $280, the cost plus the expected percent based on the normal margin. Combined would be $280. If we use the residual approach, we would take the selling price minus the standalone TV minus the standalone selling price of the remote to show the installation service of $100. Let's now talk about issues that make it more difficult to determine when revenue should be recognized. So we'll discuss things like licenses, franchises, bill and hold arrangements, consignment arrangements, and gift cards. Licenses allow the customer to use the seller's intellectual property. Licenses of functional intellectual property transfer a right of use of the seller's intellectual property. The seller's activities during the license period are not expected to affect the intellectual property being licensed to the customer. Think of a music download. In that case, revenue is recognized at the start of the license period when the right is transferred. Licenses for symbolic intellectual property transfer a right of access to the seller's intellectual property. The seller's ongoing activities are expected to affect the benefit the customer receives from the intellectual property. Think of an NFL trademark granted to a company over a period of time. In that case, revenue is recognized over the period of time for which access is provided. In a franchise agreement, a franchisor grants to the franchisee the right to sell the franchisor's product and to use its name. Franchises are often include a license agreement as well as goods and services transferred at the start of the franchise, as well as over the life of the franchise. Each of these aspects must be evaluated to determine if they qualify as separate performance obligations and accounted for accurately. A bill and hold sale involves an arrangement where a customer purchases goods but requests that the seller not ship the goods until a later date. Since the customer doesn't have physical possession of the asset until the seller has delivered it, transfer of control has not occurred, so revenue typically wouldn't be recognized until actual delivery to the customer occurs. In consignment arrangements, the consignor physically transfers the goods to the other company, the consignee, but the consignor retains legal title. If a buyer is found, the consignee remits the selling price, less commission and approved expenses, to the consignor. If the consignee can't find a buyer within agreed upon time, the consignee returns the goods to the consignor. Given that the consignor retains the risks of ownership, it postpones revenue recognition until sale to a third party occurs. Then we have gift cards. Sales of gift cards are recognized as deferred revenue, and then revenue gets recognized when the gift card's redeemed, or the likelihood of redemption is viewed as remote. So we're going to talk about issues that make it more difficult to determine when revenue should be recognized. Licenses are rights to use the company's intellectual property, such as software, technology, and media. Some licenses transfer a right to use that intellectual property that has a significant standalone functionality, meaning it can perform a function or a task or be played or aired. The benefit the customer receives from the license isn't affected by the seller's ongoing activity. So examples of this functional intellectual property would include software like Microsoft Office, drug formulas, and media content like books, music, and movies. For licenses of functional intellectual property, sellers recognize revenue at the point in time that the customer can start using that intellectual property. Other licenses provide the customer with the right of access to the seller's intellectual property with the understanding that the intellectual property does not have significant standalone functionality. Rather, the seller will undertake ongoing activities during the license period that benefit the customer. The seller might make changes to the intellectual property over the course of the license, or could perform marketing or other activities that affect the value of the license to the customer. So examples of this symbolic intellectual property would include trademarks, logos, brand names, and franchise rights. For licenses of symbolic intellectual property, sellers recognize revenue over time because that is when they satisfy their performance obligation. Sometimes functional intellectual property also requires revenue recognition over time. This happens when the seller is expected to change the functionality over the license period and the customer is required to use the updated version. For example, that's the case with some software products, like virus protection. In that case, we view the license as transferring a right of access, so revenue must be recognized over the license period. Finally, sometimes a license isn't considered to be a separate performance obligation because it's not distinct from other goods or services provided in the same transaction. An online service might grant a license to customers to access content at a website. In that case, the license isn't distinct from the website content because the purpose of the license is to access the content. As a result, the website access and license would be treated as a single performance obligation, and revenue would be recognized over time.